Hello all, welcome to the video lectures by Shivananda Sharma Memorial RV College. SSMRV College, one of the premier institutions run by the prestigious RV group of institutions, has come up with a unique initiative to engage students at the time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, Vidya of BCom department has posted a video on the subject Advanced Financial Accounting on the topic Sale of Partnership to a Limited Company. Please watch the video till the end and like, share with your peer groups and subscribe to our YouTube channel. Thank you. In this video lecture, a problem has been taken up on the chapter Sale of Partnership to a Limited Company, and the solution for that problem is explained. Let us read out the problem given to us. Mahadev and Govind are partners sharing profits in the ratio of 2:1, and their balance sheet on 31st March 2012 was as follows. So the balance sheet is given to us. On the liability side, we have creditors, bills payable, Mahadev's loan, that is nothing but partner's loan. Mahadev is a partner. Then Mahadev's capital, Govind's capital, that is the partner's capital, and reserve fund. On the asset side, we have cash, bills receivable, debtors, stock, and machinery. They agreed to sell the business to a limited company and the company to take over the assets including cash and liabilities as follows. Machinery at 8,000, stock at 17,500, debtors at 25,350, bills receivable at 2,500, goodwill at 3,000. The company agreed to take over creditors at rupees 19,500. The expenses of realization amounted to rupees 150. The firm received rupees 20,000 of the purchase price in rupees 10 fully paid equity shares and the balance in cash. Pass journal entries and prepare necessary ledger accounts in the books of the firm. So what do we understand from this given problem is that Mahadev and Govind are partners in a partnership firm. So the partnership firm is taken over by a limited company. So this partnership firm is selling its business to a limited company. So the partnership firm is referred to as the vendor firm, and the company which is taking over the assets and liabilities of the vendor firm is referred to as the purchasing company. So the purchasing company takes over the business of the partnership firm. So it takes over the assets and liabilities. For this, they will have to pay the vendor firm what is referred to as the purchase consideration. So what is purchase consideration? It is the consideration paid by the purchasing company to the vendor firm for taking over the assets and liabilities of the vendor firm. So this is paid by whom? It is paid by the purchasing company. To whom is it paid? It is paid to the vendor firm. So the purchase consideration is to be paid or is to be calculated first of all, and only then it can be discharged. So the first step is the calculation of purchase consideration. To calculate purchase consideration, I will have to consider the agreed values of the assets and liabilities taken over by the company. So what is agreed value? Agreed value means the value which the purchasing company has agreed to pay to the assets and liabilities of the vendor firm. So the problem also gives us the agreed values of the assets and liabilities. And the purchase price is to be paid partly in equity shares and partly in cash. So this is what is given to us in the problem. So the first step is the calculation of purchase consideration, since it is not directly given to us in the problem. We will have to calculate purchase consideration under net assets method. So we are given the agreed value of assets and liabilities taken over by the purchasing company. So the total of the agreed value of all the assets taken over minus the total of the agreed value of all liabilities taken over will give us the amount of purchase consideration. So in the given problem, I have taken all the assets taken over by the purchasing company at agreed values. The total of the assets will be 56,500 minus liabilities taken over by the purchasing company are creditors and bills payable. So the total of that is 24,500. So the liabilities are deducted from the assets. So what we are left out with is 32,000, and this is the amount of purchase consideration. So the next step after the calculation of purchase consideration is how this amount has to be paid to the vendor firm. In what form should the purchase consideration be paid to the vendor firm? So we have no doubt calculated the amount of PC is 32,000. But how should this be paid to the vendor firm is the second step. So as per the problem, 20,000 of the purchase price is to be paid in the form of equity shares, and the balance is to be paid in cash. So out of 32,000, 20,000 is paid in the form of equity shares. That means the balance amount of 12,000 should be paid in the form of cash. Once the PC is calculated and discharged, the next step is closing the books of the vendor firm. So now the business of the vendor firm is taken over by the purchasing company. So the books of the vendor firm is to be closed because the vendor firm does not continue its business. So the ledger accounts in the books of the vendor firm is what is given to us here. The journal entries are also asked in the problem, but here we are only going to look at the ledger accounts. So which are the different ledger accounts in the books of the firm? So the first account is realization account. So what are the entries that comes in realization account? So the first step is to transfer all assets and all liabilities at book values. So the assets are transferred on the debit side of realization account and the liabilities are transferred on the credit side of realization account. The entry for transfer of assets is realization account debtor to various assets account. So on the debit side, we'll have to write down the various assets, the list of the assets at book values. Similarly, the entry for the liabilities transferred to realization account is liabilities account debtor to realization account. So the entry comes on the credit side of realization account. Again here, liabilities are to be transferred at book value. One important point that we'll have to make note of is partner's loan is not to be considered here. Partner's loan is to be treated by preparing a separate loan account. So here partner's loan will not be transferred in realization account. So apart from partner's loan, all other liabilities are transferred at book values. Then the next step is the purchase consideration due. The entry for that is purchasing company account data to realization account. So on the credit side of realization account, the entry will be by purchasing company account, 32,000 is the amount of PC due. Then the next step is the payment of realization expenses. So realization expenses, the entry will be realization account data to cash account. So on the debit side of realization account, we write down the entry as to cash account rupees 150. So since all assets and all liabilities are taken over by the purchasing company, there is no asset or liability that is left out. So thereby we will have to close the realization account. So we total the realization account. We take the total of the realization account. If the total on the credit side of realization account is more than the total on the debit side, so that means it has resulted in realization profit. If the total on the debit side is more than the total on the credit side, so that means the realization has resulted in loss. In both these cases, the profit or loss on realization should be transferred to partner's capital account. So in this given problem, the total on the debit side is more. It is 64,650. So that means it has resulted in loss. The realization has resulted in loss. So the amount of loss is 6,150. So this 6,150 has to be transferred to partners' capital account in their profit sharing ratio, which is 2:1. Then the next account that we are supposed to prepare is the purchasing company account. Here we make note of two entries. The first entry is for the purchase consideration due. The entry will be purchasing company account data to realization account. So on the debit side, we write it as to realization account 32,000. And the second entry is for the discharge of purchase consideration. How is the PC received? So the PC is received in the form of equity shares and cash. So the entry will be equity shares in purchasing company account debtor 20,000, cash account debtor 12,000 to purchasing company account. So thereby the total on the debit tallies with the total on the credit. The account gets closed. The next account is partners capital account. So in partners capital account, we first transfer their capital balance on the credit side by balance brought down 15,000 and 10,000. Then if we have any accumulated profits, general reserve, P&L account, reserve fund, so that also needs to be transferred and distributed among the partners. So that again comes on the credit side of partners capital account. In this given problem, we have reserve fund. So this reserve fund has to be distributed among the partners in their profit sharing ratio, and this should be transferred to their capital account. So the reserve fund is distributed in the ratio of 2:1. So in terms of amount, it is 2,000 and 1,000. So the total on the credit side of the partner's capital account is 17,000 and 11,000. If there is realization profit, now that we would have transferred on the credit side. But in this problem, we have loss on realization. It is not profit. Since it is loss on realization, it comes on the debit side of partner's capital account. So the entry will be to realization account 4,100 and 2,050. So next, we will have to distribute the equity shares and cash that we have received from the purchasing company among the partners. So how should this be distributed? So equity shares should be distributed in the final claim ratio. So how do we arrive at this final claim ratio? I will explain it to you in the next slide. And whatever is the balance amount remaining after calculating the final claim ratio and distributing the equity shares, whatever balance is remaining in the capital account, so that has to be paid in the form of cash and their account is to be settled. Then the next account that is prepared is equity shares in purchasing company account. So in this account, we write down on the debit side what is the total amount of equity shares received by the vendor firm, and on the credit side how these equity shares received is distributed among the partners. So as I've already mentioned, equity shares is distributed in final claim ratio. The next account which is very important in this problem is Mahadev's loan account. That is nothing but partner's loan account, because Mahadev is one of the partner. So it is the partner's loan account that is to be prepared. So partner's loan is a liability. So the opening balance comes on the credit side of the loan account. So by balance brought down, it is 10,000. So this loan has to be now cleared. So partner has given a loan to the business, to the partnership firm. Now since this partnership firm does not continue its business, it's getting dissolved. Now it has to pay the loan amount to the partner. So this loan is paid in the form of cash. So the entry will be Mahadev's loan account debtor to cash. So on the debit side, we write down it as to cash account 10,000, and thereby the loan account is closed. Then the next account that we'll have to prepare is the cash account. So in the cash account, we write down the opening balance of cash account, and the same amount is transferred to realization account on the debit side in realization account. So here that entry comes on the credit side, or alternatively we can skip this entry both on the debit as well as on the credit side. So the entry for 150 rupees can be skipped on both the sides. So we can start with the purchasing company account entry on the debit side. So in cash account, what comes on the debit side is the amount of cash that is received, and what comes on the credit side is how this cash is utilized to make the payments. So we have received cash from purchasing company. It is to the extent of 12,000. So this will come on the debit side. And how is this 12,000 utilized? So this is utilized to pay realization expenses of 150 rupees. Then we have paid Mahadev's loan 10,000, and the balance is paid to the partners to settle their capital account, to close their capital account. After paying the equity shares, whatever is the balance left out, the balance has to be paid in the form of cash. So their account is closed. So how do we calculate final claim ratio? The working note is given here. So the total on the credit side of partner's capital account is first taken. So the total on the credit side of partner's capital account is 17,000 and 11,000. Now from this credit total, if there are any debit entries, we will have to deduct that. So in this problem, since the realization has resulted in loss, we have an entry on the debit side as well. So this loss amount has to be deducted from their capital balance. So after deducting the amount of loss, the amount left out is 12,900 and 8,950. So this itself is the final claim ratio. If possible, this can be further reduced. So you can divide it and further reduce it. So the final claim ratio, or it can be retained as it is. So the final claim ratio, if it is reduced to further, will be 258 is to 179. If you are finding it difficult to reduce it further, you can keep it as 12,900 is to 8,950 as it is. Not an issue. Then in this ratio, that 20,000 equity shares must be distributed among the partners. So the number of equity shares is 2,000 equity shares. So 2,000 equity shares of rupees 10 each comes to rupees 20,000. So 2,000 shares, of the 2,000 shares, the first partner Mahadev's share is 258 divided by 437. So that means he gets 1,181 shares of rupees 10 each. So the amount comes to 11,810. For Govind, of the 2,000 shares, what he gets is 179 divided by 437. That is 819 shares of rupees 10 each. So in terms of rupees, that will be 8,190. So this is how the equity shares are distributed among the partners in the final claim ratio. You can directly take 20,000 and distribute it among the partners also, so that you will directly get 11,810 and 8,190. So I hope this video was helpful to all of you. Thank you.